Following the extraordinary monetary policy stimulus which took place following the 2020 COVID-19 crisis and the resulting economic boom which followed, normalisation was to be expected and has already begun in many countries. Dispersion among central bank normalisation has been large this year, and we believe this will continue to be the case going forward into next year. Assuming no further crisis, tail events, we can expect a continuation of this monetary policy normalisation into next year. However, we do think that current market expectations, notably in the US, may be too optimistic. We have been advocating since the end of last year that inflationary pressures would not be transient, as expected by many central bankers. The Fed finally made a U-turn at the end of November, with Jerome Powell saying it was probably a good time to retire the word transient inflation. Hawkish remarks from Fed members around a potential earlier liftoff has led to markets essentially completely pricing a full 25 basis point hike for the June meeting, and the market currently expects somewhere between 2 to 3 hikes for 2022. We see the macroeconomic context in 2022 as challenging for a major hiking cycle to start, putting us at odds with the current market expectations. Looking at previous tightening cycle, it is important to put into context asset purchases, tapering, and rate hikes. The Fed waited a year after ending quantitative easing before its first rate hike at the December 2015 meeting. It then waited another year before the second hike. Of course, the macro picture in 2015-2016 was markedly different from today. In particular, inflationary pressures were muted and the job market was quite robust. However, the takeaway from this historical context is that the Fed has largely shown cautiousness over the last few years, letting shifts in policy flow through and assessing the outcome before engaging further. Saving rates have declined significantly, so we do not foresee significant pent-up demand. At the same time, new capacity is being brought online and we expect some supply issues to ease into the early part of next year. Moreover, food, energy and other commodities are responsible for half of the headline inflation this year, with less volatile components such as shelter, medical care grew at an elevated but more sustainable pace and only contributed 1.9% to the 6.2% year-on-year rise in the CPI. Absent of any extraordinary surge in these core components, we believe that we are unlikely to see elevated price pressure as does experience this year, heading into next year. One indicator which reinforces our call is that many commodity forward curves are currently in backwardation. Indeed, the spot price of many commodity markets is currently higher than future prices and has generated a downward sloping forward or inverted curve, suggesting that supply might outweigh demand or that inventory levels are expected to rise. Heading into next year, we believe inflationary forces will therefore peak. This does not necessarily mean inflation will fall back to the Fed's 2% target, but rather it will ease considerably, therefore relieving pressure on central banks to tighten too fast. Virus variant fears and its potential impact on growth have recently heightened short-term uncertainty. It is also important to recall what happened earlier in August with the Delta variant, which proved not to be a game changer for both equity markets and, more importantly, macro momentum. We remain positive over the medium term and we feel the growth environment should continue to support markets. In addition, we have the view that we will get fewer hikes from central banks than is currently priced in, as we expect inflationary pressures to ease into next year, further supporting our narrative.